For decades, American crises arrived one at a time. A housing bust, a banking panic, a pandemic. The systems bent, but they didn't break because they took the hit separately. What this analysis shows is something different. A dozen load-bearing systems are weakening at the same moment, and they are weakening each other. Start at the fiscal foundation. The federal government now spends $1.1 trillion a year just servicing its debt, money that flows to bondholders instead of power grids, hospitals, or pension backstops. That crowding effect matters because it arrives precisely when states and municipalities have no slack left. States run out of money to cut represents $62 billion in structural budget exposure. Rainy day funds already drawn down, federal transfers shrinking. Meanwhile, $47 billion in bank loans are resetting at triple the rate borrowers originally underwrote. Regional banks holding commercial real estate are caught in a vice, rising debt costs on assets whose values are already falling. Hackers are hitting the infrastructure that underpins daily economic life. Aging water systems, power grids, hospital networks. The estimated exposure is $16.3 billion, but the real cost is operational paralysis in systems that have no modern fallback. Student loan payments have restarted, pulling $20 billion in annual consumption directly out of household budgets. That is $20 billion no longer flowing into retail, rent, and savings, right as consumer confidence is already cracking. When Americans stop trusting institutions, employers, markets, growth slows measurably. This threat carries $151.7 billion in risk, not because of a single event, but because eroding confidence is a multiplier that makes every other threat hit harder. Here is where the threats begin feeding each other. Insurance loss breaks home. Sales, $228.9 billion in exposure, is quietly doing to the housing market what subprime did in 2007, stripping the financial infrastructure that makes property a tradable, lendable asset. Regional banks holding those same properties as collateral, states whose tax revenues depend on property values, and private credit funds entering their first real downturn, $59.7 billion exposed, all cite at this same intersection. One crack propagates through all three. The horizon threat that ties it all together is Social Security's 2033 cliff. Under current law, the trust fund exhausts and benefits must be cut automatically. $276.5 billion in annual exposure, hitting the exact population with no ability to absorb the shock. The most exposed balance sheets are the ones built on continuity. Retirees expecting full Social Security, regional banks with no rate buffer, state governments without reserves, and households whose home equity is now uninsurable. The grey rhino is the risk you can see coming and still fail to act on, visible, large, and underestimated until it is no longer possible to step aside. Every threat in this analysis is in plain sight. The danger is the assumption that someone else is watching. This is Blindside, FASTMaster's Structural Threat Intelligence series. Follow the full US macro risk analysis and every sector that follows, because the time to understand a structural break is before it becomes the headline. This is Blindside, because the risks that matter most are the ones hiding in plain sight.